Thank you very much. Good afternoon, everyone. This is the County Employee Retirement Systems Finance Committee. It's February 19th, 2024, and I call the meeting to order. Now can we have the legal public statement? Mr. Bronco.
Sure. This is a regular called meeting of the County Employees Retirement System Finance Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. The connection cannot be reestablished within 30 minutes. The meeting will be adjourned and rescheduled to a later date.
Thank you. Ms. Rankin, can you do the roll call, please?
Yes, sir. Mr. O'Mara?
Here.
Mr. Cheatham?
Here.
Mr. Fulkerson?
Here.
Thank
you. Do we have any public comment?
Yes, sir. We have two public comments for today. The first one was received from a Mark Doran and reads as follows. The unfunded liabilities basically arose for many reasons, whether it was not paying actuarial rates, planning for COLAs, or investment oversight. The system was not properly managed. Employees/retirees fulfilled their funding responsibilities. Attempts have now been made to address the unfunded liability, which is necessary. The problem is, inflation is being ignored by both the state legislature and our KPPA representatives, especially the CERS board. It's not realistic to expect retirees to maintain a stagnated 2011 level pension benefit. The CERS board has been decreasing participating entity contributions recently instead of taking any approach to plan for a COLA. From a CERS contributing participant standpoint, I understand pensions are already expensive to fund. I also understand that people are a most important asset and deserve to be treated better than we have been. My former employer hasn't frozen the taxes I pay at 2011 levels. They can fund a retiree COLA instead of a pet project or two. Don't just read this and move on. We need you to speak on this topic and help now. I've been told KPPA and CERS don't feel as though it's their duty to actively promote any increase. It most definitely is. You're there to responsibly and fully represent your members. We have sacrificed, and it's time we receive some inflation relief. Please don't move to the next order of business until you speak about this. Mark Doran. The second one we received was from a William David Jones, and it reads as follows. Why have we not received a COLA for decades, and will we finally get some relief? Thank you.
Thank you very much, and we will pass those on to the full CERS board for their consideration. Next item is approval of minutes. Do I have a motion to approve the minutes from a meeting held on December 16th, 2023?
So moved.
Thank you. A second?
Second.
Any discussion? Hearing none. All in favor, please say aye.
Aye. Aye.
Thank you. That motion is approved. Next is the fiscal year financial results. And Mr. Lamb, do you have a presentation for us?
You're muted. Mr. William, you're muted.
Give me just a minute to pull them up. I had to reboot my system and log in by phone for Zoom, but I should be ready in just a moment.
Sure. Take your time. We've all been there. If you would like, would the committee want to go to number 7, hazardous duty request?
That would be great. That would give me plenty of time to be up and running again.
All right. Any opposition to that suggestion? Hearing none, Mr. Surratt, would you want to take us through that, please?
Yes, I can. Good afternoon. Today, all we have is 9 positions being requested for hazardous duty coverage. All of these positions are your normal police, fire, and EMT position request. KPPA has reviewed all the information, and these positions do meet the statutory guidelines for hazardous duty. The position questionnaires and job descriptions were included. Therefore, we are requesting the CERS Finance Committee approve these to go forth in front of the Board of Trustees for final approval.
All right, is there a motion to approve the hazardous duty coverage request as presented?
So moved.
Thank you. A second? Mr. Cheatham, are you available?
I was muted.
That's right. All right, first and second, any discussion? Hearing none, all in favor, please say aye.
Aye.
All right, that motion is approved. Mr. Willard, would you want to take us to the investment trust budget?
Certainly.
Tab 8.
Page 69, please, Sherry. Next page. There we go. Provide a very brief update here. Through the first 6 months of the fiscal year, actual expenses are running well below the amounts budgeted for the full fiscal year, with 75% of the amount budgeted remaining. While the majority of contracted services are in line with the amounts budgeted, I would note on the BNYM custodial fee, it looks like we're well under budget, but fiscal year to date, we had only paid 1 quarter of fees, although 2 quarters have occurred. We expect to pay 2 quarters of fees in this quarter, so we'll be up to date through the end of March. The year to date, the most significant divergence on the budget versus realized expenses has been the legal services, where only 12% of the amount budgeted for the year has been spent. We anticipate a significant increase in these legal expenses in the second half of the fiscal year as activity picks up on a number of cases. Michael may want to add some additional color on ongoing litigation expenses.
Yes, I can speak that I do anticipate some additional expense in a couple of matters, not to discuss here in open session, but I do anticipate some increased expenses there. And just that with the exhaustion of our fiduciary insurance policy, there will be the expenses paid for the officers and trustees in our ongoing litigation. Their defense will begin to be reported here on this chart as well, and those expenses are somewhat large, and so those will be reported here as well. So you can expect quite an increase there.
Thank you. Sherry, page 71, please. Investment fees and expenses are running well ahead of last year, but significantly below 2022 levels. While management fees, as we see, are pretty stable across asset classes with degrees of fluctuation driven by market values and changes in allocations. The majority of the volatility has been driven by large swings in performance-based fees, consistent with the volatility we've seen in the markets and their corresponding performance impacts. The largest increase has occurred in specialty credit and private equity, where we saw a bounce back in performance from the prior fiscal year and a subsequent increase in those performance-related fees. And we'll note that real estate has continued to see erosion of performance fees, as that's been a very challenging market. We've also seen a sharp rise in the miscellaneous expense categories, and that's primarily for strategies that rely on credit facilities as part of deploying capital. And that's really based on, as we all know, the significant rise in rates, especially on the front end. So those borrowing costs have increased over the past 2 years, which has led to an increase in the cost of those credit facilities. That's all I had prepared. Happy to answer any questions.
Any questions for Mr. Willer? All right, hearing none, let's circle back to tab 6 for the fiscal year to date financial update.
Thank you, Mr. O'Mara. Sherry, thank you. Near the bottom of that page, you'll see the fiduciary net position for the 2C pension plans at the end of the second quarter. It's $12.418 billion, which is up 13.17% from the second quarter of fiscal year 23. And that amount in 23 was $10.9 billion. And that's $1.4 billion higher. It's driven by the overall increase in the investments at fair value, which are at 13.68% or $1.4 billion higher than they were 1 year ago. This is specifically in the public equities investment asset class, which is up 18.59%. Other asset classes are also up significantly from the prior year, including core fixed income, which is up 16.06%, and real return, which is up 42.68%. If we move on to the statement of changes on page 7, the increase in fiduciary net position for the 6 months ended 12/31, it's $580 million, and in comparison to the prior year of $173.9 million, that's $406 million higher. Through Q2 of fiscal year 24, the C pension plans received $621 million in contributions. They paid out $656.9 million in benefits, refunds, and admin expenses. That's a $35 million negative cash flow. The same period in the prior year was $33 million in negative cash flow. And I want to point out that the net investment income for the 6 months is $616 million compared to $240 million in the comparative period. If I could, I'd like to just jump to page 10, which will be the contribution statements for the pension funds, and we'll go back and visit the insurance funds in a minute.
Could you stop for just a hair there for Mike?
Yeah.
Can you talk about the member and employer contributions? They're both up in double digits. Well,
yeah.
Let
me do that right here on this contribution statement.
Okay, thank you.
Get right back there. So both plans reported a positive net contribution of $50 million and $53 million respectively for the 6 months ending. If you look at these member contributions for hazardous and non-hazardous, they fluctuated a little bit. That's your question, Mr. Mayor, right? Is these member and employer contributions and why they're higher? Yeah.
Yes.
Let me do that just a second here. So the increase is due to the increase in employer salaries for hazardous members. So their salaries are up 13.14% year over year. And so for the hazardous plan, that's why you're seeing the member and employer contributions up, is because the salaries are up. The non-hazardous plan is up in employer contributions, which are $30.3 million or 10.08% more than the prior year. And that increase is in employer contribution, and it's driven by a 10% increase in employee salaries. And the employer rates are really consistent year to year. So last year they were 23.4%. This year they're 23.34%. And so it's really the salary increase which is driving that employer contribution up. The member contributions are also up 10.35% or $7.1 million due to the increase in employer salaries. Did that help answer your question?
Yes, I was wondering if it was total number of participants or whether it's salary base or a combination of both.
So I did not break down the number of employees. I just looked at the total salaries, but that's something I can definitely look at year to year and get back to you on.
It's just a curiosity question. I appreciate it.
Yeah.
Bill, we are seeing news articles that across the country, city and local employees employment is up as far as the numbers. So, and that we're seeing in cities and local, same thing we're seeing at state levels, that they're finally beginning to catch up with salaries. So it'll be interesting to see what Mike finds, but I do think that's a national trend, increase in salaries at city and local level.
Thank you.
Perfect. So let me just finish out a little bit of the comments related to this statement here. So we did talk about the contributions being up. The outflows for both plans were higher than the prior year related to more benefit payments and refunds being issued. So 19.8 million and 8.1 million higher for each plan respectively. The unrealized gains for both the non-HAS and the HAS plan were positive 316.9 million and 112.4 million, which is right. Yep, Sherry's got her arrow right on that. And if we drop down to the cash flow piece of this, you'll see that for the non-hazardous plan, we're minus 52.4, and we're positive 16.9 million for the hazardous plan. If we take all the investment activity out of the financial statement there. Questions on that? And if not, I'll jump back up to the insurance statements, which are, I think, on page 8, sorry. So if we look at the bottom of that, you'll see the fiduciary net position for the 2C insurance plans at the end of Q2 is 5.1 billion, which is up 11.87%. This is a $540 million increase and is driven by the overall increase in investments, which are at 11.55% higher. Specifically, the public equities investment asset class is 17.07% higher from the prior year. Moving down to page 9, you'll see that the increase in the fiduciary net position for the 6 months is $195 million compared to 71, almost 72 million in the prior year. And through Q2 of the fiscal year, these insurance plans received $40.6 million in contributions. They paid out $103 million, mostly in healthcare premium subsidies. That's a $63 million negative cash flow. The same period in the prior year was a $31 million negative cash flow. And the net investment income for the 6 months is $258 million compared to $103 million in the prior year. If we go down to page 11 and look at the contributions and a little bit closer for these funds, you'll see that those employer contributions are only 2 million compared to 47.1. And the reason for that is, where's my reason for that? It had to do with the rates. Because they're fully funded plans, the employer contributions rates are much, much lower than they were in the prior year. And I want to talk a little bit about the net contributions here. They're 8.4 for the non-hazardous plan and minus 14.6 for the hazardous. If we take out that investment income and move down to that cash flow chart, you'll see that the net contributions are minus 30.4 million and minus 32.6 million for the hazardous. There was also a 45.1 million less in employer contributions. That's what I'm talking about. I already talked about that. Yeah, the 47.1 versus the 2 million up on top is because of the rates. And then there was a little bit of difference in the Humana gain share payment from year to year also. The unrealized gains for both the HAS and non-HAS, or for the non-HAS and the HAS plan, were positive 120.4 million and 56.1 million respectively. Any questions on the C financial statements?
Mike, can you address on page 8, or Steve, for both of you, please, your note 8?
Steve, I'd be happy to defer to you if you want to talk a little bit about that Mesa West account.
Sure. The Mesa West, which is real estate debt, was moved from specialty credits in our asset allocation to real estate under the assessment that it was more of a real estate mandate than it was a specialty credit mandate.
So it's just a reclassification of that particular asset?
Yes.
but it was originally bought as a real estate, or excuse me, a specialty credit.
Yep. It was originally bought as a real estate. It was moved under specialty credit when specialty credit was formed. There wasn't a specialty credit allocation at the time.
Okay.
That change occurred at the same time that the opportunistic bucket was removed when the asset classifications were changed.
Okay.
Anything further on that?
Was this done as a overall review of investments and asset designations, or?
Yeah, it was done when we reviewed all of, in our alternatives bucket, which is really the bucket that's there maybe is not an apples to apples with the asset categories that we've implemented in the IPS and the asset allocation to ensure that all of the asset categories, the asset mandates were in the appropriate categories.
Okay. Thank you.
You're welcome.
Sherry, I think I'm going to be on page 16. Maybe not. I was going to look at the outstanding invoices. Yes, there we go. I think I got these a little bit out of order this quarter. I apologize for that. The 12/31/2023 amount of $3.2 million in outstanding invoices is 2% higher than the 9/30 amount of $3.1 million. The top 10 employers are listed there. I want to note that the top 5 all have 3 stars by their name, and that's because their invoices have been turned over to legal for further action. These are still the same 5 that were there in the prior quarter. Kentucky River Regional Jail is omitted employer. Covington is pension spiking and reinstatement. Kenton County Airport is pension spiking. City of Fort Thomas is pension spiking, and Livingston County Fiscal Court is monthly reporting and health insurance reimbursements. If we drop down to page 17, you'll see the penalty invoices for the quarter. There was 12 of them that were waived, totaling $24,000. We had 20 penalty invoices created for $20,000 for the quarter, and a total of 40 penalty invoices were paid during the quarter by the employers. And now I think we can get back up to the admin budget, which is on page 13. So let's start with page 12. Thanks, Sherry. Page 12 is the new summary, budget to actual, that I actually put comments in for publication. I will continue in this meeting to present that summary as well as the detail and discuss the detail as well, which is a page below. But under the personnel staff subtotal, we've spent $17 million, or nearly $17 million, which is 49% of the budget. Within this category, we see that all line items have more than 50% remaining. Sherry, if you want to jump down to page 13, they can see the detail of that. Perfect. Except for workers' comp, but the workers' comp is a one-time annual fee that's already been paid for the year, so we shouldn't see any more charges in that line item. For legal, in total, we are right on budget, but there are some specific line items that are approaching their annual capacity. We are watching those closely and will adjust within the legal categories as needed. For the auditing line item, we were billed for the ACFR by the APA at $215,000. We still have $85,000 left in the budget. We do anticipate a $35,000 invoice or so for their proportionate share audit that's ongoing right now. And all other personnel categories and line items have more than 50% capacity left, bringing the total category to $20.1 million for the first half of the year, with 51.86% left to spend. And this is higher than last year in total by 6.96%. The next category is the operational category. At the bottom, it's at 2.3 million with 66.12% of the budget left to spend. This is $243,000 or 11.93% higher than prior year. We see increases in the computer software equipment line item, which is 25.36% higher, or $261,000, but we are still well under budget. Our postage is also 60.15% higher at $56,000, but also well under budget. The total budget prior to reserve is 24.6 million, with 58.96 left to spend, and is 7.4% higher than the prior year amount of 1.4. Happy to entertain any questions on the admin budget. That bottom chart's the breakdown based on the approved hybrid percentage. We can then move on to, I think we have some bank fees on the next page. Yes. Since for this fiscal year shows the earnings and fees that, as you can see, the last 3 months, October, November, December, we transitioned all accounts to hard interest earned accounts, and we're no longer having their earnings credit offsetting fees. And so the fees are being accumulated separately and will be billed to us at the end of May. And each individual bank account at Chase is earning hard dollar interest at a current rate. And I think the rate for most of the months of this quarter was 3.75%. And that shows you the dollar amount of interest in that second table that we earned in the clearing account, the C and the K accounts, and the state police account, and the total interest. And above, you see the fees. They're averaging about $7,000 to $8,000 a month, and we will get, like I said, a big invoice at the end of May that we will pay directly. But this is the method that we've chosen to do going forward with those accounts, so that we can track the interest as well as the fees separately and distinctly in the Chase accounts. I think that's all I have.
Excuse me, at the end of your presentation then.
I believe
Any
so.
questions for Mr. Lamb? All right, I think we jumped around just a little bit, but I think we're ready for tab 9, strategic planning process. It's on page 73 of the board books. And I will turn this over to Mr. Owens to make a presentation, please.
Thank you, Mr. Chair. This process has been ongoing for a little more than a year and a half. I believe KPPA determined that they would start a strategic planning process in the last 6 to 9 months. Once they made that determination, the C Board determined that it was important that we move in coordination with KPPA. So just very recently, the KPPA determined the 4 buckets that they will use in their strategic planning process. They also named a strategic planning champion who is sitting across from me now. So the 4 buckets are governance, organizational excellence, customer service delivery, and infrastructure and key resources. So we wanted to look at objectives that we had in the C Board and see how we would slot them or fit them into the 4 buckets that KPPA has identified. So this is a beginning of the process. The chairman and I just put some placeholders in place for us to be able to review, have conversation about, think about, and ultimately refine. The goal will be for us to have final objectives, final strategic goals in place by the May Finance Committee meeting, so that by the end of the fiscal year, we can meld those into the strategic planning process that KPPA is doing. you'll see here that we've identified to start 4 objectives that we would like to meld into the KPPA strategic planning process. Over the next couple of weeks, I'll have a conversation with members of the committee to talk through in detail these items, any suggestions or additions that you might have, so that we can formulate a final roster of objectives that we would like to see. And here you can see that under governance, we want to look at something related to the ACFR, the issues around that. Under organizational excellence, it relates to policies and procedures and escalation policies. And then under customer service, how we've started, we just want to make sure that everything that we're doing in a regulatory sense is updated and codified. So with that, I'll take any questions that the committee may have.
It is not a major issue, but we discussed the sequence of the 1, 2, 3, 4. A fairly good length. Is there a logical sequence? And we concluded there was, and it's different than we started right there. But when we concluded, is different. You might circle back to Rebecca, and she can fill you in on some of the rationale.
Yes.
May I also add, the KPPA board itself will see all this and have an opportunity to tweak it and approve it. But this is, the staff thinks that these 4 are reasonable and flexible enough to meet our needs. So we're happy with these 4, but the KPPA board will see them, but hasn't yet.
Yes.
I had one follow-up question, maybe for Ms. Atkins. Under infrastructure, do you think we need anything related to financial software development or transitions, or is that further out in the planning process?
I think we will absolutely have that within the KPPA version. I don't know that it has to be in the CERS piece, but for sure, I think we're going to see some tech changes for financial.
Okay.
Software, excuse
me. And maybe very significantly.
Well, I think if we can support that, we certainly should. Whether it's just a statement of support might be considered as appropriate. Any other comments, suggestions, questions regarding the strategic planning process for the Finance Committee? All right, hearing none, this is a regular meeting. Are there any other business that you want to bring before the committee? Going once? All right, then there being no further business, this meeting stands adjourned. Thank you all very much for your time.